Good morning. My name is Scott Rudd, the Chief Strategic Officer of T3Live.com. Welcome back. First day back in my studio since since the storm hit, since the hurricane, and I just want to say I hope everyone that's watching this is in a good spot. I know that it feels like a lot of lives have been turned upside down, and it's just very unfortunate. And at this point, I'm hoping that every day that we see moves us further away from what, the position that we were all in, whether you didn't have power, whether you were in water, whether you were damp, whether someone got injured or got, hopefully not, didn't die, so there's been deaths in this. Just about a lot has gone on. Lots gone on in the world, I feel like. Lots gone on in the markets. In the past 2 weeks, we have a new president. President Obama was reelected, and whether you like it or you don't like it, that is who we have in the office, and hopefully he'll get done what he thinks is important for all of us. We know that, once he got reelected, the market quickly turned right to the fiscal cliff, right to the problems that, Washington's facing on getting some kind of compromise together on whether or not we could avert some of the dangerous conditions, whether it's tax increases or whether the budget deficit. Just there's a lot going on there that they have to deal with. We just got out of an earnings season that was definitely lethargic, unimpressive. A lot of market participants tried to pretty much work that in or price it in, but between the earnings that came out this quarter, the forecasts that were definitely not what people wanted to see, the continued choppiness out of Europe, and then what we're going through in Washington, that the market just continued to the downside. And going into the election, we were already in a corrective process. Starting in early October, it was October 9th or 10th, the technology broke its 50-day moving average, the composure of the market changed. We talked about it many times. IBD went to correction. At that particular point, we were hoping people would go to tactical versus portfolio approach. You guys saw by our virtual trade floor that we went from holding many positions with a hedge back to actively trading for cash flow because we had no idea how deep this corrective process would go. So here we are, a few weeks later since I've done a call. So what I want to do in the sector spotlight is I want to check the temperature of the markets, of this sector, see where we are, try and talk about different time frames because I do still think, equities aren't dead. A macro long-term trading plan should be in store. But here, what we do is we try and hit the sweet spot, the intermediate trend, which is how we maneuver and how we pretty much make a living, but everyone does it differently. So if you take a quick look at the chart here, we'll go first into the SPX, which is the S&P cash. So what's important here is, if you remember back in June, all right, this was the June 4th low. From here, two trends developed. This was the low that actually the 200-day moved up, but we broke through real quickly, which we'll get to later, that created this intermediate trend line. An intermediate trend line that really didn't get tested more than once throughout the course of this rally, and this was in late July. And then once some things in Europe started to get a little bit more clarification, whether it was Draghi, when he said they'll do everything in their power to get rid of the convertibility risk to keep the Eurozone together, we started to have this accelerated trend line. All right, so two trend lines to follow depending on what type of trader or market participant you are. And this time we were following the 8 and 21 day. And then, we started getting a little toppy up here. You remember September 14th, remember when the oscillator hit, right there, it was plus 60, it was a time to sell some strength. Then you needed to figure it out. And what happened was, this was, remember that jobs report that was sold, another faulty signal? And then really, you came down, broke this accelerated trend, held the intermediate trend, came back up, and then this is really when things started to get a little wishy-washy. This was actually October 19th. This was, after technology already broke some key moving averages. So this was right here. So right on this situation, or right on this trend line, is when you could have switched some gears if you didn't do it already, because right around here is when IBD went to market correction. The way they say that is the condition means you should be in heavy cash, you should not be heavy in positions. They actually say you shouldn't be in any positions, but we all know that you have to be in some. So anyway, that was right here. So even if you missed that, it looked as if it could have been, close to rally back on. But you know what? It was a fake out here. It was a triple top, which typically doesn't happen. Usually you hear double top. This was a triple. So on this day was your way out. Okay? Came back below, broke this trend line. And then, right here, this was very important also. Okay, remember we started talking about, will 1403 to 1408 hold? And you didn't know that. I didn't know that either. So we were trading versus level on Twitter. I'm like, trade a level versus a level. 1403, 1408 was the floor that was trying to hold. And then look what happened on the day, we got a newly appointed President Obama right there. Boom. I thought if we had a president elected, we could maybe continue or try and stay above it. But you know what? It sliced it, and I was long that day. You had another decision to make. I was long spiders. I was long a little Apple. So I said, if we break this floor, okay, because I'm trading a level versus a level, 1408, 1403, I'm out. I think I got out of my spiders that day 141.5, and then we continued all the way down to the 200-day. The last thing I want to see guys do is get shaken out of their positions. Hopefully you didn't chase and buy here. If you missed this sell signal, or missed getting a little lighter here, maybe you sold there. So this way, on Friday, I was saying, I'm going to test longs. We were down 8 handles. I'm like, we're through the 200-day, and it's time to see how we handle it. So, what I talk about with the 200-day is this, which we've seen it in many different stocks, and it's just my thought process and strategy. Sometimes, by the time you get to the 200-day, you missed all your opportunities to sell, and they try and capitulate the last people holding on out because they know there's a lot of stops at the 200-day. Because typically, if you break the 200-day, it's showing, really the damage adding up and how weak or how weakened the technical picture is. Back in June, we broke the 200-day, and then within 2 days reclaimed it, so it became a pivot low, and that's what started the rally. But then you go back a year ago before then, all right, we broke the 200-day, and then it just never looked back, and we went down another 10 to 11%. So right now we're trying to figure out which environment are we in. Are we going to hover here for a little bit, reclaim it, and then try and get some footing into the end of the year? Or does Washington not come up with a deal? Does the numbers, from the storm and from Europe, and they start to unravel, and do we get a further, deeper correction? And right now, nobody knows, okay? People say they think they know. All we could do is measure the action, trade a level versus a level. Right now, it's still tactical. And for you who have a long-term plan, hopefully you're just in tier 1, and you use some of the sell signals that we just went over there. So at this point, we go back to the chart of the S&P, you will see that this is very important. You now have, write this down, 1373. That was the low from Friday. Here is the broken area. This is going to be very significant resistance. Okay, it's going to be hard for this market to get back above it. Even lower than that, this is right there. This is your 1401. 1401 is right where the moving averages are curling in. So let's see how we handle this area. Do we hover here? Go nowhere, create a bear type flag, kind of like what happened right here before continuation to the downside? Or do we try and snap back up and stocks act a little bit better? Because remember what happened here, this was your last bear flag during this decline. Okay, you take a look at this decline right here, and you will see that from this high here this high was what, 1415, we came all the way down to 1266. This was one last push lower, and the 200-day was right around there. It's when it broke this little key area, so you could just do it like that. And then it reclaimed it quickly, and then showed some commitment to it right around here. So let's see what happens this time, because we broke this area. Will it reclaim it quickly, then show commitment and go, or will we hover here with no interest, with a very lethargic tape, with stocks continuing to break down? Because then if that happens, we're going to see some lower prices. And if you take, let's just go a little bit more in depth here. Okay, you go from let's do some fibs here. I've showed you this and off the charts many times. You go Fibonacci retracement. Here is the low. That's the low from June. Here is your high. Okay, so right there, we are now right at the 50% retracement. Okay, right around 1370 is what held. All right, remember, 25% retracement means there's momentum, there's continuation. If that breaks, that means it's slower. 38.2%, that means that it's still a very strong market. The 50% retracement is still okay. It's still okay, it shakes things up, and here's your last line of defense for this particular rally from this low, comes right in at the 61.8% retracement. So it still could even work its way down to 1345 and still be considered, decent. Because if you look right here, I just want to show you, just to show you historically, okay, look what happened. Remember this crazy outside day? This was unbelievable. Remember back then on October 4th, you had your huge move up that was fast and furious. Look what happened with this Fibonacci retracement. From here to the highs, okay, it actually came and went all the way down to the 60, to that 0.618% retracement before, look at this fast line back up, before this major wedge that took place that led to a great first quarter rally. And it's happened in the same time period, November, December. So with that said, here we are right into this spot. So they just stopped a lot of people out. It could mean it needs a lot more time because, again, we're still up 12% or so for the year. You're still, if you look at this overall move from the, even this low here of October, the retracement's even less. So if you traded it for like a year trend, besides back in the bottom in back in that March, I just don't think you abandon stocks. You just need to know your time frame. So with that said, again, you need to know where you live. And for me, I live in intermediate time frames. And at this particular point, I've been very tactical, just trying to make some cash flow until I see a better setup. If we go into technology, thank goodness technology, I hate to say it, thank goodness it was so weak, because it tells traders that you have to be cautious, that you have to be in more cash, that you need to maybe be leaning short. And technology broke its key moving averages and it went well below the 200-day before the S&P, giving you, it was like basically a leading indicator to the downside. And if you go to the Qs, you will see, in close up here, it had very faulty signals well before the S&P. This was a head and shoulders top pattern that came in. This is when we broke the 50-day. This was actually October 9th. Okay, so it broke the 50-day for the first time, since this little fake out here, back in July. So right there, and it closed with authority below it. Look what happened here. Here, like went a little bit through it, held the trend line, and then continued. This one broke it with authority, and that's when IBD went to market correction, came back, and if you missed that, here was your retest. So sometimes there's always a retest to sell some stock or even just get short. And on this retest, the support, which was the neckline right here, turned into resistance and boom, turned down. And then if you missed that, here is your trend line that got broken right around here. So that was at least a better sell spot than finally when it broke its 200-day. So now with technology is hovering below the 200-day. It's trying to get a little bit of footing. This is definitely a problem spot. So right here you have resistance in the Qs. The low is right around 64, 65. So let's see how it handles this lower portion here. Kind of go sideways, build a little bit of a base, and then perhaps break this descending channel, which is very steep that it's in, and then continue to the upside, which will probably need some time to go sideways and to even think if that could happen. Or do we break below this low and things start to unravel? So you have to watch very closely. Watch this 63.13, see if we go a little bit sideways, and then perhaps we break this descending channel, and that would actually be a positive for the market. So we'll watch that way, the way that develops. Two stronger spots that have been that started to sell off were the banks. The banks were really strong going into the presidential election, and then right there, boom, the day after, they all went down 5-6%. They all started down 3%. I was trading from my RI office. I was long Bank of America that day. I'm like, you know what? I don't know what's going to happen here. But typically a potent down day like that leads to more downside. So I was out of most of my things by 10 o'clock. And thank goodness, we talk about stepping off that landmine and losing a limb versus sitting there waiting and blowing yourself up if you can't handle it. And if you look at the XLF, you will see that it fell very fast. It was trying to hover here. This was the last breakout. This was your last little trend. Here is your 50-day moving average for the last round of momentum commitment. So this was your out right here. If you didn't want to be in it, on an intermediate time frame, it looked like it was holding up. It was trying to be the strongest group. This was your out, and now it's hovering below. And you need to see what's going to happen here, because does it play catch up and get down to the 100 or 200 day, or does it go sideways? And then if we regroup, this would be a sector to go to. But you take Goldman Sachs, which I'll go into key stocks later. Some guys were long this one. It was looking the best, right? This was from the last breakout. Here is your trend line. It closed at the highs. That's a horrible fake out right there. Closed at the highs, boom, trapped everyone in this range here. This right here could have been your out, and then broke the 50-day, and it's very far removed from its moving averages. So I would use this as a gauge. Maybe it tries to snap back and see if it could get back above this area. If it can't, it's going to need time. But the banks itself, a strong group that turned into, get out of the way real quick. We talk about high-level stops. Here was your high-level stop, right? Strong group trying to hold higher, trying to see if momentum can come back. you know what? It didn't break out to the upside, it broke to the downside. This was your high level stop, and if you got stopped out here, now you can figure out potentially a reversal pattern to get back in it. Now that's very important. It's part of your tactical tool belt is how you handle type of situations like that. High level stops, protect profits. When momentum leaves a sector, you leave. When commitment leaves, or if there's no commitment, you don't have it. And then you also have to have lower level stops on when things just fall apart and there's no support whatsoever, and you just want to limit your losses and step out of the way, so this way you can get back in at a better time. Now if we look at the home builders still hanging around. They're still above the 50-day moving average. So this too, this group, so to speak, is still hanging around, trying to be strong. I do believe in this housing recovery. I bought a house myself. I see what's going on out there. It's a little bit better, but again, look at the size of this move. It's had a huge move this year, let alone. So, if you're a momentum trader or an intermediate trend trader, I would have lightened up into this little area, and now you could always watch it and let it regroup. If it stays above the 50-day and then the market gets its footing, you will know that this is the sector to get back into, and I'll go over some key stocks later there. If you take a look at let's take a look at the transports. Transports, still nothing. Very lethargic range, just going sideways. I haven't really traded anything in here in a while. I don't think this means much to me, actually. Then you go to the XL. Let's see. Let's go to gold. Let's check out gold. Actually, let's go retail first. RTH. RTH retail has been a strong spot all year. Let's see where it is. Started getting a little bit choppy up in this area. Broke the 8 and 21 day, came back up, and then wound up breaking the 50-day for the first time right here. So the RTH, which is retail, broke the 50-day where you saw that home builders did not. The financials waited a little bit longer, and then now is below the 100-day. So they took a step back from their leadership role. Okay, so it'll be important to see what happens there when all the numbers start showing up. So as far as numbers later this week, a lot of people on Wall Street will be looking, if you come back to me, what type of impact the storm had. It could have had a little bit of a good impact too, right? Everyone rushed to the store, the stores and did a little bit of preemptive type work, filled their shelves, filled everything up. Some people lost power longer, some people didn't, so maybe they overshopped. So, we need to see what happens there. We need to see, what type of buying was put off during that, complicated time. But as far as the moving averages and whatnot, some faulty signals in retail, and it's now weaker than the home builders and the financials, and obviously we saw the real relative weakness in the Qs versus the S&P. So as far as the sectors right now, I'll go into some other ones a little bit later in the day. That's what we're going on here, and at this particular point, the S&P is very important to see what type of bounce or how we hold in here to figure out if there'll be some further constructive action or more deterioration. So right now I'm going to take a quick commercial break, get into some key stocks, starting with Apple, because I know everyone's on their pins and needles to figure out if that low that we put in on Friday is a tradable spot, and I'll get right into that right after the break. See you then.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Back in the trenches with some key stocks, because during corrective phases, you don't need to be across the board. You don't want to be in second, third, fourth tier stocks. You want to see how the leaders are acting, and that's where the opportunity is going to be. As far as Apple's concerned, I hate to say it, a month ago when it broke the 21-day moving average, we said now is the time to trade it, lighten up. We're getting away from our swing trade approach with Apple because, momentum left, and you never know what's going to really happen. But if you're out of the way, you don't have to know. You can measure it along the way, because then it broke the 21-day, then it went to the 50-day, then it went to the 100-day, and then finally it broke the 200-day. And let me just show you on the chart, okay? Because I'm going to go over it again. Here's where it broke right there, broke the 21-day moving average. Here's where it tried to hold the 50 at a small bounce, broke it, came to the 100-day, little tiny bounce, came back, retested. This time it was a little bit of a bigger bounce, but still controlled by these moving averages. And then it led to a move to the downside, broke the 100-day here, led to a pretty precipitous decline One of the 200 days, as I remember, was right around here. Actually, it moved down a little bit because of the way the action moved, but this was right around here, right around your, this was 587 to 590, and then it stayed below it and continued. So we finally saw somewhat of a red dog reversal on Friday. I am long Apple right now. Traded below 535.29, came back above. I would have liked to have seen a little bit of a stronger day there, maybe something like we saw here, and then holding higher, so we'll see. So today what I'll be looking for cash flow is I want to see if it could take out Friday's high. I want to see if we can get above 555-ish. If that's the case, your next micro level is 564, and then you have more of a key area, which would be a gap fill up to the 580. And I know everyone wants me to say, okay, Apple's going to make new highs in the year at some point. It could take 3 months, 6 months, 9 months. Who knows? At this point, what I will say is let's take it a little bit day by day. If you sold it correctly, when it broke all the key moving averages, and you see this little reversal pattern here or on Friday at 535, that was your entry, and now we measure it. We see what type of commitment will we have to Apple, so we know what type of commitment we will have to it. If it gets above, right now it's gapped above 550. If it stays above there and continues higher, no reason to sell. You could sell some, trade it through cash flow. Like if it trades through, Friday's high, you add some, sell some, and then you stick with some if you want to try and use that as a swing, because that is a decent swing entry, but we don't know yet. Okay, so at this particular point, you go back to the chart of Apple, you will see that it's below all the key moving averages, a little bit of a red dog reversal pattern. If it could get set up and get through 555, that will be step number one. Then you have 564, and then here's bigger resistance. So at this point, we'll just have to measure it as it goes. I'm hearing that there are some, lifts on the supply constraints. You can go to some Apple stores, get an iPhone 5, and that the iPad demand is good. And I do think that, a lot of people are bashing this stock, and I don't think it's one of those stocks where it's game over. The PE is 12. I still think their product line is awesome. I think it's going to be one of the hottest products that would be flying off the shelves. I just think sentiment got a little bit too harsh on it. It went too fast as far as even the corrective process of the market. So at this point, that's the level to trade against, and we'll figure it out as we go. Let's go into IBM. A lot of people love this stock. This is why we don't take stock into earnings, because you never know what's going to happen. And here it gapped down, and then what happened? It didn't fill the gap. So our rules there. If it doesn't fill the gap, it could stay in the direction of that gap. So came down, broke this low, broke the the 200-day was a little bit higher then, came back, retested it, sold to the downside, and I still think you have to be careful here. It's a broken stock as of now. It's below all the moving averages. You have a ton of resistance right there. If you want to trade it versus this 188.88, and then you have a really big level down here. I would watch IBM because that'll help give some clues on what the market might do. Overall, it's still it's very elevated, so there is room to the downside. So don't think it can't go down if it doesn't want to. So know your time frame. This is level support 1, and this is a lot bigger right into this 180. If you want to go Google, talked about what happened there with earnings. Okay, that was also a very important day. Remember that day it was halted? That was the day that IBM was breaking down. Google was halted. Another momentum stock off its perch. Time to get a little lighter in other things. Broke down. And what did it do? Created a bear flag, right? Never was able to get back above this area. And then I do think some guys made some money as it broke this key support, which was around 675. So it's above the 200-day. It's kind of right back where it was, where it broke out. Some guys tested it on Friday, a little reversal also. I think, see how it handles this 675 now. Okay, so this could be just a trade, and if it hits this resistance and fails, and maybe it can continue lower. But right now, what I would do is I would trade against this 650. I tweeted, I think, on Thursday saying, 645, 655 was your area to cover shorts if you were still short. And some of you guys tactically probably took along, and now we'll see, if we can reclaim this resistance or not. So see what type of range we get here and see what type of action. It'll give us clues also. A lot of guys looking at Caterpillar. Stock's been broken for this entire year almost. Ever since it broke this area right here, which was prior breakout area, prior support, broke the 200-day. Here's a good example of something that broke the 200-day back in May. Never reclaimed it. That's when institutions show you that it's for sale, and it's been for sale, and it's been in a void ever since, besides some minuscule trades. So right there, it shows you when the 200-day actually could be a line of defense to sell. Hopefully, you saw a high, lower high, lower high, when it broke support. That was your time period. So down here, question is it an opportunity? And at this particular point, it's trying. Trying is the key word here, trying to hold this lower level. This is very important right here. This is your 82-ish area. If it doesn't hold 82, it could definitely see these lows again. So just be very careful here. This actually is a little bit of a head and shoulders pattern also. Left shoulder, head, right shoulder. This neckline could be support, but if it doesn't hold and fails, it's below the moving average, it can continue. Did close near the highs on Friday. Did show some relative strength on a micro basis, right? Closed at the highs. So see how it handles these moving averages. So it's something to watch. Guys wanted me to look at GE. I'll put GE up also. GE at this particular point, after earnings, didn't show. It got hit. It was on a perch, right? And another reason why you don't take stock into earnings. Here's a small little reversal right before it. Broke this area. This was your signal to get out, and it's still above the 200-day. It's below the 100-day. At this point, if you did sell prior to earnings, maybe you buy some versus 2050, but it's going to take time. A lot of these stocks are just going to take time. Netflix has been, you can pull your hair out. Ever since Icon got in there, you had some extra strength, and every time it looks like it's going to break above 80, it fails. I guess the daily chart is still intact, but it's definitely not easy to trade. One of these days, it's going to break out of this range, and I know my traders are continuing to watch it. And until it finally gets above this 80 and maybe holds above it for 15 minutes, it's going to be hard to get a trade here. But at this point, you have a perfect bull flag, a lot of hair pulling out in this whole area. Maybe it gets above 80 and goes. It's still on the radar. And then lastly, just because I'm running out of time, I feel like I could go on for 2 hours, but then you'll never see the morning call. It'll be past the open. Gold started acting better. This broke out in August with silver. It actually held the 200-day, bounced off it. Take a look at the chart here of GLD, and you will see that it did have a better bounce than most other things. I'm not sure exactly what to read into it. If you look here at the chart, you will see this is resistance that held. This was around 1,800 an ounce. Then this is when we were trying to figure out if momentum would stay here, and then it broke the 8 and 21-day. That was your lack of commitment area to get out. Came back, held the 200-day. You look a little closer now. I'm not sure. It did hold up better than others. It did bounce off key support. It's coming back into resistance. So I would just be careful right around here, right around this 169 to see if it fails here or busts through it. And if it busts through it, it's showing you some power. But here's a big day. What was that? That was on 11/6. And it's shown some continuation. It's trending. So as long as it stays trending like this, stay with it short term and longer term. Guys, just you have your own agenda. So good luck with it at this particular point. It's still in the game. At some point, for it to really get going, it's going to have to get through this 1,800 an ounce. And at this point, this chart's still showing nice sideways action after a major trend that's been in place for years. So with all that said, I have a lot to say. I really should be going on more, but I can't. Futures are up, I think 3-4 handles right now. Stocks are trying to bounce off of very oversold levels. Got to measure resistance 1, 2, and 3 to figure out, is this the easy tradable bounce, or is it penetrating through levels that if it was that weak it wouldn't get through, which could be pointing us to more constructive potential higher prices. But if the bounce is feeble and there's no support and there's no participation from all the groups and we can't really get out of this area, unfortunately, you have to trade against that 1373 in the S&P, and if that breaks, that 1345 is that last Fibonacci retracement that held last year around the same time. So I will try and be on the radio. Sperling will be in here. We'll try and guide you through it. Have a great day trading. It's great to be back. See you at the recap. Good luck today.